All right, hey, in this video, let's talk about the drawbacks to whole life insurance here. And I wrote 3 of them here because this is a common thing that you got to look out for. Obviously, mainstream media, if you're following Dave Ramsey, Suze Orman, you know, they bang on. I mean, they're just doing talking points to the mass audience. But if you drill down and understand the product a little bit more in detail, there are drawbacks. And the first one you got to look at is, you know, what is the time to capitalize? And what do I mean by that? And, you know, forgive the drawing right here, but more, we're going to drill down instead of trying to be stylistic here. But time to capitalize. Now, if you do a heavy 100% base, as you see right up there, what I mean by that is if you fund that with 100% of just life insurance, you have a high mortality and expense charge. That's going to take 10 years plus to get your money back. So let's say, for example, you got premium payments $100,000 in, you have $100,000 in 10 years, which is not the best. So you got a 1 to 2.5% internal rate of return if you're looking out 20 to 30 years on that policy. Okay, so that's the number one, time to capitalize. That's a big one there. The second one is minimum premium. Most people think with a whole life insurance, they need to pay premiums their whole life. And that's not the case. You can structure a policy where you can fund it for 5 years, 7 years, 10 years, and then stop payment. So there's flexibility, but it must be paid initially. So let's say, for example, if you fund one at a 50% base, meaning the mortality expense charges, 50% are designated towards that, and then the rest, 50%, in paid up addition, which is not towards the death benefit. You can see there it takes 7 years plus. So for example, let's say again you put 100,000 in, you see about the year 7 you would have 100,000. And typically if you look at an internal rate of return 20 to 30 years out, 2.5 to 4% for that. All right, and the last one here, cash value returns. People think, oh my God, cash value, whole life, is a terrible investment. Now, if you structure a policy with 10% base, meaning 10% designated for the death benefit, again, you're reducing your mortality and expense charges. And then you're gonna see a break-even point 3 to 5 years, which means, again, if we keep this simple, 100,000 in premiums paid for the first 3 to 5 years, you're gonna see your cash value equal that, again, being repetitive here, 3 to 5 years. And then you're gonna see an internal rate of return 20 to 30 years out of 3 to 6%. So a couple things, but you do have to acknowledge, that's why policy design and how you structure this is so important. But obviously whole life insurance goes tax deferred. Obviously you can take out policy loans for tax free. But in this little short video, I just want to talk about the 3 drawbacks and really looking at internal rate of return and how that affects a policy. More information, Standing Financial. Stay tuned to the next video.